Welcome to the Deep Dive. We're here to take often complex, sometimes dense, managerial guides and, well, really break them down into practical, actionable insights for you.
Yeah, make them usable day to day.
Exactly. And today, we're tackling a really important one, financial intelligence, a manager's guide to knowing what the numbers really mean.
Hmm.
Our goal here is pretty straightforward.
Right.
Give you, especially if you're a manager outside the finance department, that essential business sense you need, to make better decisions and actually help drive results.
And right off the bat, let's define this financial intelligence thing, because it's often seen as, I don't know, some special talent only finance people have.
Right, like you're either born with it or you're not.
But the book is really clear. It's absolutely a set of skills you can learn. It's not magic.
Okay.
The whole point isn't just bean counting. It's helping everyone in the organization understand how financial success is actually measured. And maybe even more importantly, how your decisions, the things you do every day, impact the company's numbers.
And when that clicks,
Well, that's when you see commitment go up and you genuinely get better results across the board.
that really changes the perspective, doesn't it?
Mhm.
It's not about becoming an accountant overnight.
Not at all.
It's about learning the language of business.
Mm-hmm.
So the book lays out a path for this. What are the key areas we're going to explore?
Yeah, it breaks it down nicely into 4 main skill sets. First, you need the foundation. Basically, can you read the key financial statements, the big 3?
Okay, the income statement, balance sheet.
Cash flow.
Exactly. Second, understanding the art of finance. This is crucial. It's realizing that estimates and assumptions play a huge role in the numbers you see. It's not all hard science.
That's the bit that really jumps out at me. We'll definitely circle back to that. What's third?
Third is analysis. So
Yeah.
once you get the basics, how do you use tools like ratios, return on investment, ROI, that kind of thing, to actually judge performance?
Makes sense. And the last one.
And finally, number 4 is the big picture, understanding the context. How does your company fit into the wider economy, the industry landscape? Okay, good structure. But I want to go back to that second point, the art of finance, because honestly, when I look at a P&L statement, I assume those numbers are facts, objective truth.
Right. And that's a really common assumption.
But the book says, hold on, not so fast. So let's unpack that. Why aren't these numbers always the straightforward facts we think they are?
Well, think about what accounting has to do. It needs to put a number on things that aren't always easy to measure objectively, like how long will this big, expensive machine really last?
You can't know for sure on day one.
Exactly. Or will all your customers actually pay you what they owe? Probably not. But how much will be bad debt? You have to estimate. So finance relies heavily on established rules, yes, but also on estimates, on assumptions, on judgment calls.
And that's where the bias comes in.
Precisely. It's not necessarily like bad bias, but it's an inherent skewing one way or another because of these necessary interpretations.
Okay, so it's built into the system because you have to estimate certain things. Can we talk about depreciation? That seems like a classic example.
Perfect example. Let's say a company buys a machine for, say, $10 million. They don't just subtract 10 mil from profit in year 1, right?
They spread it out.
They spread it out. They estimate its useful life, maybe they say 10 years. So they deduct $1 million a year as depreciation expense.
Okay.
But what if, I don't know, 5 years later they realize, hey, this thing's built like a tank. It's going to last 15 years, easily.
So their initial estimate was conservative.
Right. So they can actually change that estimate, that judgment. It's perfectly legal.
And what does that do to the numbers now?
Well, if it lasts longer, the annual depreciation charge goes down. Less expense means
Higher profit, instantly.
instantly higher profit. The company didn't sell anything extra, didn't cut costs elsewhere. They just changed an assumption on paper and boom, profits look better.
Wow. Okay. That's a legal judgment call, but it clearly impacts the reported results. What about other ways companies manage perceptions using these judgments? You mentioned one-time charges.
Yeah, the big bath. That's a classic maneuver.
Taking the big bath. Sounds ominous.
It kind of is for that one quarter. Basically, a company decides to lump all the bad news together. Restructuring costs, writing off old inventory, settling lawsuits. Everything negative gets crammed into a single reporting period.
But why would they do that? Wouldn't that make that quarter look absolutely terrible to investors?
It does look terrible, but here's the thinking. You take all the pain at once, you clean the slate, so to speak.
And then,
And then future quarters look much healthier by comparison because all that bad stuff is already dealt with. It helps create a narrative of, okay, we had a tough quarter, but now we're recovering, things are improving.
so managers need to look beyond that single bad quarter and see if the underlying business is actually getting better.
Exactly. Look at the trends, not just the one-off hit.
Okay, but maybe the most critical area, and where things can go really wrong, is deciding if a cost is a capital expenditure, CapEx, or an operating expense, OpEx.
This is absolutely fundamental. And yeah, potentially dangerous territory.
Explain the difference again, simply.
Okay. Operating expenses, OpEx, are your everyday costs. Salaries, rent, utilities, marketing, they hit your income statement immediately, reducing profit right now.
Got it.
Capital expenditures, CapEx, are different. These are investments in long-term assets. Buying a building, a big piece of machinery, new software systems, these go onto the balance sheet first
As an asset.
as an asset, and then only a portion of that cost, the depreciation or amortization, hits the income statement each year over the asset's life.
So the impact on current profit is much smaller for CapEx than for OpEx.
Way smaller, and that's where the temptation lies. If you could somehow treat a regular operating cost as if it were a long-term capital investment,
You'd make your current profits look much, much higher.
dramatically higher. And the most notorious example of this, the one everyone points to, is WorldCom back in the day.
Right. What did they do specifically?
Well, they had these huge costs associated with leasing phone lines from other carriers to run their network. These were basically like paying rent, a clear operating expense.
Should have hit the income statement immediately.
Absolutely. But they started booking these costs as capital expenditures, billions of dollars worth.
So they treated rent like they were buying a building.
Pretty much. And by doing that, they hid those massive expenses from their current profit calculations, inflating their earnings by billions. It was one of the biggest accounting frauds ever.
Until it all came crashing down.
Yeah.
It really highlights how crucial understanding that distinction is for anyone reading the financials.
It's where reality can get seriously distorted if you're not careful.
Okay, that's a perfect lead into the next section. If things can get that subjective, we need to get back to basics. The three statements. And you mentioned the critical difference for managers is profit versus cash. People often use those terms interchangeably.
Oh, all the time. But they are fundamentally different things. Profit, remember, is an estimate. It's calculated according to accounting rules like revenue recognition and matching expenses to measure performance over a period.
It's an accounting construct, essentially.
Right. Cash, on the other hand, is, well, cash. It's the actual money in the bank. It's the reality that pays the salaries, pays the suppliers. You can't fudge cash easily.
Okay, and here's where it gets really interesting, as the book points out. Profit relies on things like revenue recognition. You count revenue when you earn it, not necessarily when you get the cash.
Exactly. You deliver the product, you book the sale, even if the customer won't pay you for 60 days.
And the other key concept is the matching principle.
Yes, the matching principle is vital for profit calculation. It means you have to match the expenses incurred to generate that revenue in the same period you recognize the revenue.
So if I sell something today for $100,
You book $100 revenue today. And if it costs you $40 in materials and labor to make that thing, you also have to book that $40 cost of goods sold today, even if you paid your supplier for those materials last month.
okay, matching revenue and the cost that generated it in the same time frame.
Right. And because of these rules booking revenue before cash comes in, matching costs, you can end up in a situation where your income statement looks great, showing healthy profits.
But your bank account is empty.
Exactly. The book uses this fantastic example, the Sweet Dreams Bakery.
Tell us about the bakery.
Okay, picture this. Business is booming. Sales are climbing month after month. Their gross margin is good. Profit looks solid on the P&L statement. They are, on paper, a profitable, growing company.
Sounds great. What's the problem?
The problem is their cash cycle. They pay their suppliers, flour, sugar, all that in 30 days. Standard terms.
Yeah.
But their customers are big grocery chains, and they take 60 days to pay the bakery.
Uh-oh. I see where this is going.
Right. They're paying out cash every 30 days, but only getting cash in every 60 days. So as the business grows and sales increase...
That gap between paying out and getting paid gets wider and wider.
Precisely. They're constantly funding that 30-day gap. The faster they grow, the more cash gets sucked into receivables. By month 3 in the example, despite showing profits, they're actually $30,000 short on cash.
Wow. So their own success is draining their cash.
It's a classic growth trap. And the big takeaway is stark. profitable companies absolutely can and do go bankrupt if they run out of cash. Managing cash is paramount for survival.
Okay, let's look at the other side of the coin. The book also gives the example of the fine cigar shops.
Right, the retailer. Now, this business in its early months is actually unprofitable. Revenue isn't quite covering all the startup costs and overhead yet. The P&L shows a loss.
So on paper, they're losing money.
Correct. But here's the twist. Their bank balance is actually increasing every month.
How does that work?
It's the opposite cash cycle. As a retailer, they collect cash immediately when they sell a cigar. Cha-ching, cash in hand.
Okay, instant cash collection.
Plus, they negotiated really good terms with their cigar suppliers. They don't have to pay their wholesalers for 60 days.
So they get the customer's cash on day 1, but don't have to pay their supplier until day 60.
Exactly. They're essentially using their supplier's money. It's called a cash float. They hold on to that cash for 2 months before it goes out. So even though they're not profitable yet, cash keeps piling up in the short term.
So the immediate lesson there is cash is king for staying live day to day. The cigar shop survives because it has cash, even while unprofitable. The bakery struggles despite profits because it's cash poor.
Right. Now, eventually, the cigar shop does need to become profitable to be sustainable long term. You can't live on float forever. But it highlights that cash flow dictates survival. Warren Buffett famously said he focuses on cash flow statements because cash is hard to fudge. Profit involves estimates. Cash is just cash.
Okay, that profit versus cash distinction is huge. So once managers grasp the statements and that core difference, how do they use this knowledge? That brings us to analysis, right?
Yeah.
Ratios.
Exactly. Understanding the statements is step 1. Step 2 is using ratios to actually analyze performance. Ratios are powerful because they let you compare. Compare results to last quarter, to your budget, to your competitor.
I give you context.
They give you context and help you spot trends or potential problems much faster than just looking at raw dollar amounts.
And they can be early warning signs, too. You mentioned the Sunbeam story earlier.
Yes, with Andrew Shore, the analyst. That's a great case study in ratio analysis. Sunbeam, under CEO Chainsaw Al Dunlap, was trying to make its numbers look amazing.
And they were doing some sketchy things, right? Like bill and hold.
Yeah, they were basically recording revenue for products they hadn't actually shipped yet, stuffing sales channels. It made Q4 1997 sales look incredible, illegally so.
But how did the analysts catch it?
While the headline revenue number looked great, Shore dug into the balance sheet. He calculated a key ratio. Days sales outstanding, or DSO.
What does DSO measure again?
It measures, on average, how many days it takes for a company to collect the cash after making a sale. So it's directly linked to accounts receivable.
Okay.
Shore saw that Sunbeam's accounts receivable had absolutely ballooned way out of proportion to their reported sales growth. Their DSO had gone through the roof.
Meaning they weren't collecting cash nearly as fast as they claimed they were making sales.
Exactly. It was the huge red flag that indicated something was seriously wrong with those reported sales figures. It exposed the whole sham.
That's powerful. And it shows how these ratios directly connect to what non-financial managers do every day, especially around working capital. Remind us what working capital is.
Simply put, working capital is current assets minus current liabilities. Think of it as the short-term funds needed to run the day-to-day operations. Managing it well is crucial for cash flow.
And DSO is a big part of that. How do managers outside finance impact DSO?
Directly. If you're in sales, the credit terms you offer customers directly impact DSO. Offer longer payment terms to close a deal. DSO goes up. If you're in customer service or collections, how quickly you resolve issues and collect payments affects DSO.
It's not just a finance metric, it's an operational one.
Absolutely. Let's use the book's example. A company with $24 million in daily sales. If their DSO is 40 days, that means they have $960 million tied up in accounts receivable.
Wow, that's a lot of cash waiting to come in.
Now imagine the sales team tightens up payment terms slightly, or collections improves efficiency, and they reduce DSO by just one single day.
From 40 days to 39 days.
Right. That one day frees up $24 million in cash, instantly available for the business to use. That's the kind of direct impact managers can have.
Okay, so managing how fast customers pay is critical. What's another lever within working capital? Inventory.
Definitely. Days in inventory, or DII. This measures how long, on average, your cash is tied up in inventory before it's sold.
And who impacts that?
Lots of people. Engineering impacts it by designing products. More complex, customized products often mean higher DII because they don't move as fast.
Makes sense.
Sales impacts it by what they focus on selling. Pushing standard, high-volume items usually helps lower DII. Purchasing impacts it by how much they order. Ordering huge batches to get a discount might increase DII if it takes ages to sell through.
So every day that inventory sits on the shelf, it's basically frozen cash.
Frozen cash, and it's also at risk of becoming obsolete or needing markdowns. You want inventory to move efficiently.
Okay, so we have DSO receivables, DII inventory. What ties it together?
The big picture metric here is the cash conversion cycle. It basically combines these. You take your DSO, add your DII, and then you subtract your DPO days payable outstanding.
DPO is how long you take to pay your suppliers.
Right. So DSO plus DII minus DPO gives you the net number of days your company's cash is tied up in this operating cycle, from paying for inputs to collecting cash from customers.
And the goal is?
The goal for every manager should be to help shorten that cycle. Collect faster, lower DSO, move inventory quicker, lower DII, and, where appropriate and fair, optimize payment terms with suppliers, manage DPO. Shrinking the cycle frees up cash.
This really reframes things. Financial intelligence isn't just about reading reports. It's about seeing how your actions affect these key levers, receivables, inventory, and ultimately the company's cash health.
Exactly. It empowers you to ask better questions about the numbers, understand that crucial profit versus cash difference we talked about, and then actively manage the parts of the business you control to improve financial performance. You become a genuine steward of the company's resources.
So the long-term benefit isn't just for the individual manager's career, it's for the whole organization.
Absolutely. When you have more financially intelligent managers across the company, you get better decisions, higher trust because people understand the why behind actions, and ultimately improved corporate performance. It connects everyone back to the fundamental economics of how the business actually makes money and stays healthy.
It builds a stronger, more resilient company overall.
Definitely. Now, thinking back, we talked earlier about that whole tricky area of CapEx versus OpEx and how WorldCom got into trouble treating operating costs like capital investments to boost profits.
Right, the temptation to make the numbers look better in the short term.
Well, that leads to a really practical question for you, the listener. When you're on the other side of that, when you're the one proposing a capital expenditure, let's say you need significant new equipment for your department. You have to build a business case, justify the investment financially.
Okay, standard procedure. You need to show it's worthwhile.
Exactly. So the question is this. When you're doing that justification, there are different methods finance uses, things like simple payback period, internal rate of return, or IRR, and net present value, or NPV. To make sure your decision truly adds economic value to the company, which of those methods should you primarily rely on, and maybe more importantly, why? What should you really be focusing on in that calculation?